But honing in on this plan, having those three things hammered down is the biggest way that you can eliminate emotion and that emotional reaction to the environment that is going on around you. And that's how we become a robot. If you're just pumping out these trades, you got your entry point, your stop loss, your sell target. As soon as you either hit that sell target for a victory or you get stopped out for a loss, you're then moving on to the next trade. The last thing you want to be doing is playing the what if game. By all means, you want to look at your trades and review them and utilize that information for future trading. But if the trade hits your sell target and you exit for, say, $300 and that's your target, and that's exactly the goal you set out for, and then you look back and see that the stock kept going up and you say, oh man, if I kept holding, I could have had $500. That kind of lament doesn't do you any good. You set a goal, you hit the goal, you were successful in the trade, move on and find the next trade. And in terms of consistency, I have here base hits versus home runs, and the difference between those, home run is when you make a big score, and that can get you in a little bit of trouble in the sense that you get comfortable and complacent looking for these big wins, and then you might have a whole bunch of losses in between, and relying on those big wins to keep you afloat is not a good game plan. Going for base hits, small trades, getting those winners, and having those winners pile up. We had a member in the chart, guys, who 1 week went 2 for 7 in his trades. 5 losers, 2 winners, and he went break even. And that's because his stop losses were tight. He let his 2 winners ride. And if you can go break even when going 2 for 7, think about where you're going to go if you have a good week. And that's all about that consistency. Base hits, lock them in, move on to the next trade. So in terms of time frame for the plan that you're establishing, it all depends on the style and what you're going to be going for. Are you day trading? Are you swing trading for multiple days or maybe multiple weeks? Are you a long-term investor? Are you scalping, which is a scalp trade is a minute move, maybe just a few pennies that usually requires high capital. We'll look at an example of all of these, but your style and personal preferences need to be recognized, and you do that with the practice that we're going to be looking at with paper trading and seeing what kind of play you like the most. So we're going to be looking at a few different plays here to help determine your style. Trial and error, obviously, and the trial part is paper trading, and that error results in no losses. You're learning about yourself, you're learning about the trading game, and benefiting your future self by keeping that capital. So the time frames, what's most important, and that can get a little overwhelming for people. You have the 1 minute chart, 5 minute, 10 minute, 15 minute, 30, 60, daily, weekly, monthly. What do I look at? Which is most important? And that all depends on the kind of trader you are. If you're looking for a scalp, the 1 minute and the 5 minute are important. If you're looking as a long-term investment, you're looking at the weekly and maybe even monthly. And if you're looking for just a bounce, you're looking at the daily chart. So we're going to go over some examples now of all of these different little time frame scenarios on when you would be looking to enter and exit a trade and establishing that trading plan.